Happy New Year and welcome to the very first episode of 2025. This is actually season 4 of the podcast. We're here with your Wednesday Night Live to update you on the real estate market, update you on what's happening in the economy, and more importantly, give you some insight as we head into 2025. Josh, welcome. Happy holidays. Happy holidays.
It was a nice holiday, Jeb. I know you and the family took a nice trip. My wife and I had a different one this year. My wife is a Christmas baby. Her birthday is 12/28. Her best friend from college, we've all been friends forever, December 24th. So we didn't have any big plans this year. So we said, let's go to Cabo. So we did a Cabo Christmas, which was unique and different and not super Christmassy, but the resort down there did a great job of having special Christmas festivities, having a nice sleigh by the pool. It didn't really go. It was a little incongruous, but we had a good time. How about your Christmas?
Mammoth for the holidays, day after Christmas for 4 nights in Mammoth. Had some great snow, a lot of wind, really good conditions other than the wind, but it's a good time, but it's also nice to be back and here in front of the camera talking to you guys this week. If we're actually on this an hour early, so it's 4 p.m. versus our normal 5 p.m. Pacific Standard Time. So first off, I'd like to know what you guys think. Is this a better time? I don't even know if we can make this work, Josh, but just throwing it out there for those that are listening live. Secondly, we put our forecast out on the housing market yesterday on the Educated Homebuyer podcast channel. So if you haven't done so already, check it out. Let us know your thoughts on that. We do believe there's going to be some changes into 2025, and it'll be interesting to say the least. But it's gonna be I don't know what the right word is.
I'm ready for an uninteresting.
It's not going to be a straight line.
We've had 2 interesting years in a row. I'm ready for a boring, traditional, uninteresting year.
That's fair to say. I mean, I felt like 2023 was kind of boring-ish. 2024 was less boring-ish. But anyhow, you guys are here to find out what's happening in the economy. So we're going to start as we always do with some slides. But if you have questions, start putting them in the chat now. I know there's not a ton of you watching at the moment, but let us know where you're watching from. It's always helpful for us to know who is here along with your questions, and we'll get you rolling as we head. And then you can get some college football in. Watch the second half of probably the biggest blowout we've seen yet.
No one's going to watch the second half of this game. Barring a big duck comeback early in the second
I would
half,
like to see it.
No one will be watching.
I'm not an Ohio State fan to start with.
I don't think anyone outside of Ohio is an Ohio State fan.
That's fair. That is fair. But before we piss too many people off, let's take a look at some slides here, Josh. And we're going to start where we always start, which is inventory. And this is the time of the year where inventory continues to fall. But this year, we're starting the year at 650,000 homes. That's down from 667 last week. We didn't do a show last week, so a bigger drop than what we saw, a couple of weeks ago. But starting the year at 650,992 properties, that's up 27% more than where we started in 2024. So that's already a positive thing for those out there waiting, hoping, searching, wanting more homes on the market. So just kind of a repeat here, went from 667 down to 650. Our peak last year in 2024 was 739,000. And the low we saw was back in 2022 at 240,000. So we're making progress there, Josh, but still below where we were in 2015 for this time of year, sitting at that time back at 994,000 homes. So almost a million. This is a chart coming in from November. So that is a little bit delayed, but calculated risk. I highlighted the areas that I thought were interesting, the ones that saw the biggest jump. Not necessarily year over year, Josh, but compared to 2019, Alabama, Charlotte, Dallas, Fort Worth, Jacksonville, Nashville, Phoenix, Northwest area, or Phoenix and the Northwest of the United States, all areas that have seen an increase, not only year over year, but to 2019 levels. And we've been, something to follow here. We know inventory is increasing, but pay attention to it. Orange County, currently sitting at 2,341 homes. That's down almost 9% from last week. So even though we didn't come on here last week, we tracked the data. Huntington Beach down nearly 17%, almost 17.5% from where we were last year, sitting at 149. It's not abnormal to see inventory continue to go down this time of year. it's probably the next couple of weeks we're going to see inventory continue to move downward, and we won't see it probably stabilize until sometime early February, and then we'll start to probably see inventory increase, unless it's like last year, because last year we saw inventory continue to go down all the way into, I believe, April, May, and then that's when we saw inventory start to pick up. But if we're back to normal, we'll see it here in the next couple of weeks hit the bottom and then start to rise. So new listings last week, 32,462 compared to 24,000 back in 23, 19,000 back in 2022. And so the peak this year came in at 75,000 weekly. But if you look between 2013 and 2019, so 2013 to 2019, the peak in new listings reached somewhere between 80,000 and 110,000. So we're still below where we were during more normal times in the market, but more new listings coming to the market is a positive thing. And again, same chart here, looking at new listings. I took the liberty to put the areas that were compared to 2019 that saw the biggest increases. And a lot of them follow the same areas that we were just looking at there on the inventory chart. But the ones that I think are interesting, Josh, are more so are the one New Jersey, New York, these ones that have big decreases compared to 2019 versus some of these other markets out there.
It is wild. We talk often, all real estate is local. And I was looking here, I was trying to pull up Lance's map of the country, because it kind of shows you. The chart's cool because you can see, and these are real definitive numbers pulled from the MLS, but Lance's chart is interesting. Really, the weakness is along the Gulf Coast. The massive strength is in the Northeast. And for those of you in the Northeast, it's definitely different talking to someone looking at buying their first property in Pennsylvania than it is talking to someone looking in South Florida.
Absolutely. Total contracts pending, sitting at 269,337. So what's interesting here, Josh, is over the last 10 weeks of the year, there was actually an increase in year-over-year pending contracts compared to 2022 and 2023, despite having higher rates. So is it at bottom? Hard to say at the moment. We probably won't know until we, get some more weeks with higher interest rates actually throwing in the into the data there to see if it's actually a bottom, and we're going to see increases from here. But definitely either way higher than where we were back just the last 2 years.
Well, if you look, go back to that one real quick, Jeb. 23 and 24 are pretty darn similar. So when you look at the peach colored line and the darker red there for 2024, we were consistently above where we were the year before. So both very low. So I'm not saying, oh, this was a really strong market. But I think there is some of that you and I have talked about over the last few weeks, where some people thought there was some change or inflection or something was going to happen in 22, something was going to happen in 2023. And there's more people like, hey, life is continuing to happen, and I can't wait for what I thought, hoped, needed to play out. So even absent lower interest rate, I think the right side of that chart there for 2024, October, November, December, it absolutely was impacted by lower interest rates. And if we got lower interest rates, you would see a big divergence for the whole year to the high side. But I feel like regardless, we've kind of seen the lows in that time frame where we hit, 22, late 22, mid 2023, when rates were elevated, high sevens, low eights, and people still had that lock-in effect of just, hey, I'm going to sit and wait it out.
And it's also important to understand where the numbers are coming from, right? Context is key. We talk about it all the time, right? We've got some really low numbers over the last couple of years. So the fact that you're seeing these numbers higher than the last couple of years, probably not much to pay attention to. But either way, it's a positive sign for the housing market overall. Pending, actually not pending, price cut sitting at 36.4% compared to 35% in 2023, 38% in 2022. So a little bit less than where we were 2022, a little bit more than last year, but still more or less what you would expect. This is the latest home price forecast pulled from Resi Club. With a couple of more added on there. Again, you have Apollo Global Management sitting kind of at the high, expecting almost 11% in appreciation over the 2025 year, whereas Morgan Stanley is on the bottom now, just under just over 2% negative. So they're expecting home prices to pull back just over 2%. But for the most part, when you look at these numbers, there's an average. I think the average is somewhere 3.5, 4% somewhere is what most of these companies are expecting. year over year.
If you read into the article, Jeb, they did kind of break down, because Morgan Stanley, of all of them, kind of gave more so than just a forecast. They said, yeah, down 2% is our base case, what we think is most likely. Their worst case scenario, if rates were to creep back up, they could see home prices dropping 5%. And conversely, they think if interest rates come down, you could see home prices go up as much as 5%, which would put them at the high end of this range here. So really, if we're being realistic, ranges are a better way of doing it, just because none of us actually know where it's going to end up.
Absolutely. This just shows 12-month home price change. The problem with this particular chart, it came out today, and one of the newsletters we get is October to October, so it's delayed 2 months. But at the time, it shows that home prices went up about 4.5% in the United States. But you can see how regionally things are different. We always talk about real estate being local, just different areas seeing different things. But if you took it from January to January, I think it was either Case Shiller or one of them came out today, and it was 3.5 or 3.6% year over year in appreciation. So that's what we saw essentially for 2024, which is basically what most of these people are expecting for 2025, as we just saw. And then this next chart, Josh, I threw it in here because I turned on YouTube today, and one of the first videos I saw was that the banks are taking homes again. And I said, that idiot went and saw that foreclosure delinquencies, or that delinquencies were up. So he went out there and said, the banks are taking homes. But guys, guess what? It went from 0.52% in October to 0.53%. So 0.1%, guys, it increased, which is minimal. And in fact, it's actually less than it was in November of 2023. And less than it was prior to the pandemic starting. So nothing to be concerned with. Or if you're somebody that's hoping for the distress sales and the foreclosures to just come, they're getting ready. You got a thing to you be patient. Be patient. Hopefully that's part of your 2025 resolutions, is to be patient.
Yeah, when you see that get up to that 1% range, above the pre-pandemic, back to the 2019 levels, and then above 1%, you could call that an inflection point of trending back up. Because if you go back here, sub 1% is normal. You get a really, really healthy market. It's way below 1%, but sub 1% is normal. You start approaching 1%, getting over that. Now we might have something to talk about.
There you go. And that's going to take us into looking at inflation, core inflation, and what are we talking about here, Josh?
Really, nothing here to go into detail on each of these individual slides, other than to see all of these charts, different ways of looking at inflation. 12-month median inflation, cyclical core inflation, multivariate core trend inflation. The charts all look the same. Yeah, the improvement is slowing, but you can see we are still moving in the right direction. Here's a couple more looks at it. Cleveland Fed median PCE, Dallas Fed trimmed mean 6-month inflation rate. They all show, depending on, just look back here, a couple of them have had some little stutters and some jumps up and down, but the trend is clear. We're getting back to that range of where we want. There's a lot of talk about sticky inflation and having a hard time getting back down to 2%. We're starting to see, last couple of reads, CPI and PCE, we were able to see that home price shelter inflation is moderating, still elevated, but finally coming down and getting factored into those numbers. We've seen goods inflation, disinflation, if not outright deflation in a lot of goods. Services inflation is finally moderating. So as those continue to moderate, one of the experts we follow, David Rosenberg, Jeb, I sent you an article. He's calling for 1.9% core PCE by March. It's pretty aggressive, but they're not dummies. They're not just pulling numbers out of thin air. That's backed by a whole analysis. Doesn't mean he's right, but if we see that, then we have a 10-year Treasury that is way, way too high at above 4.5 if we have inflation at 1.9. So we usually look at these charts. I wanted to give you guys a different look at this for those of you here on New Year's Day wanting to hear about housing and interest rates and inflation. This is the 1 month chart. So every one of those candlesticks is 1 month. So we're going back here. The left side of this chart goes all the way back to 2020. So we can see On a monthly basis, uptrend is still intact. We've pointed out this wedge forming. Well, on a monthly basis, we kind of broke out from the top of that wedge. I think December sometimes can be taken with a little bit of a grain of salt. The reason why we're not going to go over a whole heck of a lot of information is the last time we were here, we had just got the PCE numbers. So we haven't got anything important until, the first 10 days or so of January. So this is really just a look at what the markets do and sort of have been doing, what the trend is. So the month there, this is the weekly, again, kind of broken out of that wedge, but gives you just another different look at it. And this is our normal daily. We are well above it, but well above that wedge, but we will see. The action is really going to happen in the next 7 to 10 days as all of the traders come back from their Christmas and New Year's vacations. They start getting some data to chew on, and we start seeing things happen. And then later in the month, Jeb, we're going to have the inauguration. We're going to have Trump come in, and we're going to see what is he actually wanting to get accomplished here in the first 100 days. So the first quarter of this year is going to be really important, and I think we're going to get a better and more valid look at what's going on with the charts here. In terms of interest rates, Mortgage News Daily still reporting just a hair over 7% for your conventional loans and a hair under 6.5% on FHA and VA. As always, well-qualified borrowers are going to get a little bit better than that, but definitely looking at elevated, kind of the middle of the range of where we've seen over the last 2.5 years. We've got as low as 6%, got up about as high as 8%, and we're right in the middle of that, waiting for some more data and direction here at the first quarter of the year.
Josh, you probably heard my phone ring then. I was actually looking at my phone thinking, should I turn that to do not disturb? But then I was like, it's New Year's. It's 4 something in the afternoon. What is the likelihood of someone calling? I mean, honestly, and then immediately it rang. So that I don't know if that was a sign.
You willed it so.
Or what. But anyhow, but for those of you out there, there's a lot of you that have interest rates that you're not happy with, and you're looking to refinance, take advantage of them as mortgage rates go down. You don't want to follow it daily. Let us do that for you. You can scan this QR code if you're available to do, if you're watching this on a TV or something, or you can go to jebsmith.net/rate watch, put in some information, and we'll be in touch with you, our team here, and they can put you on a list. And as rates move down, we can be in contact and hopefully save you some money. And even if you're not in the position where you're looking to refinance immediately, or that's not where you're looking to buy or whatever, Josh, the team here can guide you through that pre-approval process using jebsmith.net/referral, which I'll throw here on the banner as we scroll the bottom. But with that, Josh, we have some questions. We have not a ton of people watching, but we got a decent amount of questions actually at the moment. So let's do that.
So I wanted to start with this one, Jeb, and just kind of, here, let's go. Real Estate Curious says, I live in Jupiter, Florida. I have a condo. Prices have been getting crushed due to the Surfside complex collapse, HOA increases, and insurance. And then follows up with, however, my condo passed inspection with flying colors. Do you think that will help me? So first off, Jeb, why don't you walk through why? Well, what are the impacts? What are the things that are causing problems for HOAs in light of that? And what are the things that a buyer should be looking out for? And if you have a complex that did have a safety inspection and passed, how much is that going to help when condos in Southwest Florida are getting beat up pretty good?
Yeah. So for those of you that haven't paid attention to this whole thing, and you can, Real Estate Curious can, tell me if I'm wrong on some of this, but when that crash happened, or that collapse happened rather, with that condo building, what happened was the state of Florida went in and basically passed a law that said that, these buildings were going to be inspected. And what happened is they not only were they going to be inspected, but they had to have a certain amount of money in reserves, a certain percentage of their money in reserves by a certain period of time, which meant that if you didn't have that, or you had things that needed to be addressed through the building, there were going to be assessments done. There were going to be dues increases. There were going to be a lot of things that had to happen in order to meet these certain things that the state was requiring. And what happened was, a lot of these buildings were old. They didn't have money in reserves. They had issues that needed to be fixed. So you got all of these buildings getting huge assessments. Like, if your HOA dues were $500 a month, your HOA dues might go to $600 a month. But what they did was they said, hey, each one of you now needs to pay us $50,000 each by a certain period of time so that we have enough money to fix the issues that are happening. So that was one issue.
And Jeb, they may be listening and hearing $50,000. That's crazy. Nothing's happened.
I've heard
of some over 100 grand, over 100
some
grand,
were a couple
$140,000.
Yeah. Crazy amounts. And so what you have happening on top of that is you've got natural disasters, insurance companies now seeing these buildings as a problem. So insurance increases because of HOA issues, also because of natural disaster. So you've got all of these things being thrown on top of other issues, which is hurting the overall market in general. So the condo market is suffering in a lot of these places. Now, you said yours is passed with flying colors. Fantastic. So that's probably a positive thing for anyone looking at a condo, is the fact that the financials are probably good. You're not going to have assessment. Somebody comes in there, they know more or less what to expect with the building. The problem is affordability at the moment, with just in general with higher rates, but you also have the HOA fees, potential increases for things that aren't even relevant to that, just inflation or inflationary things that impact the bottom line. Those things raise dues. On top of that, you have insurance issues. So all of these different factors are throwing just, putting less buyers, less potential out there in the market. So hard to say, right? It's one or the other. What people are looking at, is it affordability? Is it other things? I would say that people probably want some stability in that market more so than anything else. And if rates move down, when rates move down, you're going to have more buyers come to the market, because typically condos are a little bit more affordable, especially in these markets. And the ones that don't have the issues are going to be a better deal for people. They're the ones that they're probably going to be more apt to go towards your condo versus others. But outside of that, it's hard to really give you any relevance to, what the future looks like, just because, these areas are overbuilt with condos to start with. And especially over the last couple of years, they've been building condos like hell. It reminds me back of, 2007, 8, when there were cranes everywhere in South Florida. I don't know if it's still like that, but I know a lot of buildings are being built, and the more inventory you have and these issues, it's going to take some time before it settles down.
The other piece on that, Jeb, is just the financing. A lot of these buildings, if you have $100,000, $50,000, $40,000, $20,000, $10,000 special assessment on that building, it'd be very hard to get financing. If you don't pass the inspection, if you can't get insurance that is acceptable to Fannie Mae or Freddie Mac, it can make the financing difficult to impossible. So you have the logical piece of it, of a buyer goes, well, I would like a condo because it's more affordable or it fits my lifestyle, but I want to be in one of the complexes that did pass the inspection, and I need to be able to get financing for it. So it's going to put pressure on the market, but definitely far less pressure on ones like this where the inspection came back positive.
All right. Justin has a question. Says, what are your thoughts on switching real estate agents? I looked at 2 houses with an agent I found online, but I'm not very confident in their expertise so far. El Dorado County, California. So Justin, at the end of the day, you're the most important piece of that equation, right? You've got to look out for Justin, not for the real estate agent. Sometimes that sucks for us as agents if you do decide to switch. But at the end of the day, if you're not under contract with an agent, you don't have to do anything other than tell them, hey, I'm moving on to another agent. If you're under contract with them for any reason, then you've got to, have a conversation to see if they'll let you out of that, and what that looks like. So that's something you have to determine there. I think it's important to vet agents up front. I talk about it all the time, versus finding just somebody online and asking them to go see a property. That's what happens a lot with these online companies. You see a property you like, you hit a button, all of a sudden you got an agent showing you a property. You have no idea who they are, their level of expertise, any of that. And you're kind of, you feel obligated. So don't feel obligated. Just not advice to tell you to ditch somebody, but it's you gotta do what's right for Justin. Anything you want to add on that, Josh?
No, I would say that the same thing. Maybe if you could just expand on, a lot of people don't know that they are more likely now to be signing a buyer broker agreement. As you said, is there a contract that locks you in? What can happen, and what should they be expecting in terms of signing an agreement with an agent going to show them houses? And is there exclusivity and a timeline involved in that?
All right, I'm gonna try to address Sam's question here, Josh. There's a lot going on, but it's Sam's asking, is there a written prompt template website outlining the eligibility requirement for first-time homebuyers with fair credit and presumably with a source of income. And then goes on to ask questions about different types of mortgages, blah, blah, blah. So let's just categorize real quickly the 4 major types of mortgages, the credit score, the minimum credit score requirements, the minimum down payment requirements for those loans, Josh.
So Fannie, Freddie, FHA, VA, USDA. And so Fannie and Freddie guidelines are not identical, but for all intents and purposes, they are. You're going to need a 620 credit score. That doesn't guarantee you'll get approved. It's the minimum to get approved. FHA goes down to a 580 with the minimum 3.5% down. You can go lower, but you're going to put 10% down. And the lower you get, almost anything below 620, especially with the minimum down, is not going to get an automated approval. So now you're looking at a manual underwrite, lower debt to income ratios, additional requirements, tighter, more aggressive underwriting. And USDA, Jeb, is it 600? We don't do a ton of USDA. USDA, every time we talk about this, they say, no, that's not right. We'll go lower than that.
I think it's 620, but I don't remember 100%. I think it's 620.
And I can say that the USDA, Gus, their underwriting system is tighter than FHA. So you are less likely to get an automated approval, and again, a little bit more restrictive on a manual underwrite. VA technically doesn't have a limit. For all intents and purposes, that 580 is going to be a number. If you had a lot of equity in your property, you're looking to do a refinance, you got a 550 credit score, you came through a bad stretch, we can get them done. I have friends who've got loans done for folks in the low 500s on a VA, but let's be realistic. Like as a goal, like someone here has as a question, let's kind of throw this in here together. Jeb Azrael says, tips on first-time millennial buyers. I'm 31, would like to buy a property before Trump leaves. So some of these requirements, like I think you should, a goal should be to get your credit score above 680, if not above 740, before you buy a home, because it's not that difficult. You can research it, you can study it, you can figure out the things that you have to do to get yourself to that point. It's going to get you much better terms. It's going to get you much better underwriting. Not that you want to push maximum debt to income, but if you can get an automated underwrite, you might get an appraisal waiver depending on what you're doing and what program. Probably not if you're going to do a minimum down, but there's some big advantages to that. So the thing that anyone can control is maximizing your credit score. So in terms of those loan programs, yeah, they'll go lower, but you're looking at 0 down FHA, 3% down conventional, 3.5% down FHA, and 0% down VA. We went through the credit scores. You want to maximize. You want to get above 680 to start getting good terms on any and all of those programs. Would love to be able to see you come in with having at least your down payment. The seller can give you a credit for closing costs. Lender can give you a credit for closing costs. But down payment and some money in reserves, even if it's not required by the program, it makes me uncomfortable when I have buyers going in and they're going to use every last nickel they have to get into the house, just because the reality is once you get into a house, you want a new TV, you want a new couch, something happens and you need to do a repair that you weren't aware of on the inspection. But does that cover it, Jeb?
Yeah, I think so. I mean, at the end of the day, I think minimum requirements is you need a 580 if you're putting a minimal down payment of 3.5%. If you have at least 10% down, possibly down as low as 500 with FHA, but FHA is going to be your most lenient program across the board. But if you're talking to a lender, have them give you side-by-side comparisons of everything that you qualify for, and then you can make a decision on what's best for you. That's honestly the easiest way. And if you need somebody to speak to, there's actually a link scrolling the bottom there that'll get you in touch with the team.
And that's what I was going to say, Jeb, is talk to someone, because you kindly started up saying, hey, I don't want to bombard you guys with a bunch of questions, but you probably do have a bunch of questions. And some of the most valuable conversations I have are with someone that says, dude, I'm not buying a house in 3 months. I'm not buying a house in 6 months. I want to buy in a year or 18 months. Okay, cool. What are your questions? What do you want to know? Tell me a little bit about where you're at, where you think you're going to be in 6 months. And we can start getting a game plan together. But a 20-minute conversation, we can answer all of your questions in specific versus broad general questions and probably narrow it down. And if you want to then go do some more research, now you're not researching everything general about buying your first home. You're saying buying your first home with a 3% down conventional loan and an 800 credit score.
Good stuff. Way to cut on your lights there, Josh, to start.
I tried. Jeb, we have an important update. The game is now 34-15, and Ohio State had the punt. So Oregon has the ball back. They may make it a game before we're done here.
That would be awesome, actually. I would like to see a game versus a blowout. with that, Chris says, always compliment. Chris might be the biggest fan of my beard, which, it's reaching its the climax, I think. Even though I say I can keep it longer, I don't know that I can. But as always, I do appreciate it. And you asked me how I maintain it. I do nothing. I show up every morning and it's still there. And then about once a month or once every 2 months, I get it trimmed a little bit. So here it is. This is what you get. This is what you get. Here we go. M. Sandoval. Hello from Central California. Wife and I are looking to lock in our rate in the middle of the month, crossing our fingers for lower rates by then. So, Josh, not really a question, more of a comment, obviously. But you know what? We got jobs report at the beginning of the month next week. Next week, jobs report. Josh, is that right?
Well, here, let me just pull up the January 2025 economic calendar.
So the things that are going to affect rates the most are jobs report, inflation. The Fed does meet in January, but I don't know what the date is for their first meeting. But it's they're not expected to do much on that front.
Oh, this is crazy. This chart, I can't. I gotta clear everything and then just what in the world? I found a difficult one. So. This week looks like next week we get ISM services, JOLTS, Fed minutes, and then we get the jobs report next week.
So next week
would be important, and then I think we get CPI the following week. But what I was going to say, Jeb, I don't think it's going to take that long. We always get a dose of reality the first couple days, trading days of the year. So that's tomorrow, Friday, Monday, definitely once everyone is back at their desks on Monday. We'll see, is there more selling pressure? Or do people come back and go, hey, I'm cool with these yields in the direction of inflation in the jobs market, and we'll push it down a little bit lower. So I would say if you get some pressure up on rates the first 2-3 days, I wouldn't wait to see what happens with the jobs report and CPI the following week. And conversely, if we see some buying action, you can definitely push a little into next week and see what happens with jobs, and possibly the following week happens with CPI. I don't really have, Jeb, if I were a betting man, this is a coin toss. To me, it could go either way when we get back. What I would say is last year, we talked through the holidays, rates got lower than they should have during that slow trading time. And this year, I think they went a little higher than they should have, but they've recovered a little bit, 5 basis points or whatever over the last week or so. But I think the first 2 or 3 trading days of the year are going to give us a good indication of what the rest of January is going to look like.
All right, good stuff. Well, Chris is saying the chart that you showed at the beginning appeared to present that Atlanta has almost 7,000 or 8,000 more homes for sale in November than it did last year. Is that right? So let's pull that up real quick here, Josh, and see what
6,500 additional listings.
Okay, but you got to also understand that was, let's see here, active inventory Atlanta, 6,500, but it's this is from November. Okay, so yeah, November, you're right. So year over year, 41% increase in inventory. Yeah, that's a lot, but understand where things were coming from, right? I don't know Atlanta market well enough to say, wow, that's a huge jump, or they're just headed back to what would normally be inventory for that market, in any given year. So pay attention to that. See if you can find some numbers from where inventory was 2017 to 2019, because that'll give you a better idea of whether or not that increase is really how it appears here, right? Because context is important, not just the year over year, but again, because the 2019 part is missing there, we don't really know.
And this chart comes from calculated risk. If the data is missing, it's because it's not easy to get. Bill tries to track down all the info he can. So if it's missing, it's just not easy to find the info.
There you go. All right. Got some people saying Happy New Year's. Happy New Year's to you as well. In fact, anybody that's watching this here tonight that shows up, we appreciate you guys. Happy New Year. We're grateful to be able to do this and actually provide some value to you. And hopefully that's what you get out of this is some value. That's why we show up. All right. Josh, what do we got here?
Azrael has another question. So advice on buying houses in California, specifically north of LA County, like Palmdale, the Valley, Bear Lake, Lancaster.
Just drove through there. Advice, it's hard to say, right? That is probably the most affordable market in what I'm going to call Southern California. I mean, it is a little bit further north of LA, but still, I guess it's called Central California, but still not really even central at that point. But yeah, it's an affordable market. I think, if the market slows down, that market will probably slow down as much, if not more. But you got to pay attention to it. It's still, you got people moving there because prices are less. It's easier to own there than it is in, say, LA or counties that surround it. It's, I would say find a good agent. In fact, I have a great agent there that's helped
Very good agent.
numerous people buy in that area over the last couple of years. So, talk to somebody that's more familiar with that market and can tell you exactly what prices are doing. But that's where I'd start, because it's a great market for, somebody buying their first home just because of where prices are.
And just sort of to double down on what Jeb said, more volatile because more first-time buyers. So imagine if it's an area where it's a lot of first-time buyers and they build up equity and then move to more expensive areas. They haven't had that time to accumulate equity. When I look around my neighborhood, most of my neighbors are really old and they've lived in the homes for 35, 40. I'm young in my neighborhood and I lived in my house for 22 years. So those people are at very little risk unless they were doing refis every 5 years and pulling money out of their house, because they bought the house for $300,000 and they've paid off the mortgage or paid it down to $50,000, $80,000. So when you have these neighborhoods where people have bought in more recently with lower down payments, there's more risk if we were to get any type of economic shock or housing shock.
Yeah, I saw a good thread today on X, Josh, Twitter. And I still have a hard time saying X. Like, can we just go back to Twitter?
I'm just tired of hearing people say, formerly Twitter. Yeah, no shit. It's formerly Twitter. We all know it's X.
Just saying X. It just seems like I'm missing part of the sentence there. But anyway, a good thread just showing, trends in pricing and stuff over the last couple of years. And, something we talk about all the time, 40% of the homes out there are owned free and clear, have interest rates below 4%, below 5%. I mean, that number is starting to tick up a little bit. It's not what it was because more people are willing to either pull cash out or sell their property, buy something else. So it's not as locked in as it was, but the amount of equity people have is just incredible in these properties. So, that's one of the benefits, obviously, of home ownership, probably the biggest benefit of home ownership. And it usually takes time to accumulate what a lot of people have been able to accumulate over the last 4 years. But it's one of those things that it's hard to predict. So you got to get in when it's right and hopefully have that longer term time horizon and be able to benefit from it. Josh, Steve says, what trends are you seeing from SoCal investors and investors in general, if any? So, there's still a lot of it depends on your investor, right? Are you a short-term investor looking for flip opportunities, that sort of thing? Because if that's what we're talking about, my phone blows up every single day from text, emails, phone calls, investors, this robo dialing. Some people I know, most I don't, trying to find flip opportunities, right? Most of these people are looking for distressed properties at, 50, 60, 70%, actually probably 50, 60% of after repair market value. So they're really looking for a deal. So there's a lot of those in the market. Investors in general, I don't have a lot of investors at the moment looking for long-term holds. And I think a lot of it just has to do where prices are, if I'm being honest. So,
Jeb, I've got a buddy who does nothing but commercial. So commercial includes apartment building. Most of those investors will move up. There are large scale mom and pop investors that own 10 or 12 single families, but they will rotate up into units. And a lot of what we're seeing is just 1031 exchanges, rotating up properties. They built up a bunch of equity in an older property. They want to get something closer to the beach, something in a higher rental area, something go from class C to class A, where they're just going to get a different type of tenant. But I don't know. I mean, I just don't know how anyone would justify parking money. Rob Dyrdek on his podcast like a year ago broke down, someone showed him real estate investing, and it was almost like at the perfect time, like 2018, 2019. And he just started just pumping his money into syndications and buying on his own big apartment buildings. I just don't see a lot of people doing that right now, just because the yield on that, the rent yields of parking a chunk of cash at today's interest rates is tough. So not a whole lot of investor activity with current market numbers.
All right, good stuff. C says, do you think real estate prices in California are going up or down? There are so many conflicting YouTubers saying there will be a crash or the opposite, the market will skyrocket. So my thoughts on California real estate is much of what we've seen over the last couple of years. I mean, not the basically 2024, parts of 2023. I think you're going to see prices probably go up somewhere between 3 to 5% is my guess, for most of California. Some of these areas that, that are less desirable in California probably won't see that. Orange County, San Diego, LA County, Ventura, probably going to see that normal, 3 to 5%. San Bernardino, Riverside, still desirable, but a little bit less. And you might have it. Affordability is affected out there more so than where we are in general, just so that area might see a little bit less. But I think overall, California is on the positive side. Not going to skyrocket and definitely not going to crash. All right, Josh, it was a good question. Well, not a really good question. We don't know. But any thoughts on the housing market in Puerto Rico? Well, my thoughts at the moment is they need to get their power back on before they can do
that. Would be number one.
That would be number one. That's first and foremost. Before you can do anything, you need power. They had, I think, an entire island. I mean, like everything, like
the entire power grid was down.
Yeah, it was down. So unless you had a generator or something else, you were pretty much affected. But it looks like, Fabian, if you live there, you have power, obviously. If you don't, you might want to invest in a house that has some form of power that's not tied to the grid. But other than that, we don't really have a lot of knowledge. I don't have a lot of knowledge of.
I know a guy that does loans in Puerto Rico. They still have access to the same mortgage system we do for the most part. There's definitely some big differences. What I will say is, for most people, it's just too far out of the realm. If you are mainland US, especially if you only speak English, that is going to be a big giant change. But I know a lot of business owners, there are some massive, monstrous tax incentives to move and locate your business there. So we had, what wasn't it, Jake Paul, Logan Paul, one of them moved out there because they could basically, for the first 5 years, keep their gains or their income tax-free while they're making a ton of YouTube money. So from that perspective, retirees love it because beach, warm weather, much lower cost of living. You get young people who have online businesses that can go there and can get some incentives to shelter a lot of their income.
Go there? Can I turn my business into online and just move to Puerto Rico? I've been to Puerto Rico. I wasn't really a huge fan personally, but that's just me. All right. Chris says, how are new home communities able to offer advertised 3 or 4% interest rates? When I got approved for an older resale home, which I prefer, they quoted almost 8%. So Josh, how are builders able to offer a lower rate than what sometimes you're able to offer?
Well, let's start with this. We had the lunatic that kept harping on about Black Friday sales, and the best number that we saw at that time was at 4.75. So when rates got really low, it could have been down in the 3, but realistically right now 4.99 is probably as low as someone is buying it down to. The reality is, those are the big national builders who have either a mortgage company affiliate or a wholly owned subsidiary that is a mortgage company. They have margins at any given time from 20 to 30% on those houses. So you buy a $400,000 house, they're making $80,000 to $120,000. So if they have to spend $20,000, $25,000, which a lot of times we've seen these subsidies, they report this in their quarterly filings, and we've seen where they were averaging $27,000, $28,000 of subsidies on the mortgages. So it really is, they're moving money from one side of the balance sheet to the other. And a lot of times that $28,000 of subsidies, they're wholesale costs. So like if you were to come to me, I think we've used this example a million times, a friend of mine, she got a $30,000 credit from the builder and we backed into it. And to get that from me, it would only take an $18,000 credit. But the builder wasn't going to give her $18,000 to get a loan from me. They were going to give $30,000 to get it from their wholly owned lending affiliate. So really, again, just moving money from one side of the balance sheet to the other.
All right. Let's see here. I saw a question, Josh, that was, I can't find it now, but we'll go with this one. It says, are you familiar with NorCal land sales as well as USDA loans? I'm not familiar with NorCal land sales in particular, but I understand how land sales work in general. NorCal is no different than any other area for that matter. But USDA loans, Josh, I know we're familiar with them. I know you don't do a ton of them, but I can say yes to this question in case they have additional questions.
Unless we're talking a USDA construction. USDA will not lend you money to buy land. So there's going to have to be a structure on it, or you're going to do a construction loan to build on it. In general, when we get these questions, that someone going, okay, USDA doesn't require a down payment. I want to get land. I want to build because it's cheaper than buying a house because I either don't qualify or don't feel like I can afford for the homes that are already built. And I don't think there's really a recipe for anywhere in the country where you can just get a piece of land, build a property on it, finance it with a construction loan, and have it end up being cheaper than just going and buying something existing. So that would be the biggest hurdle. There are USDA one-time close construction loans, but it's not necessarily the simplest, easiest process, and there aren't a ton of lenders doing them.
All right. Good question here from a seller where it says, as a seller, how much should I value a conventional loan over an FHA or a VA loan? And the answer is you really shouldn't, but most people do. So here, if I were an agent and you were the seller and we had an offer of each coming in, what I would tell you to pay attention to, for one, is who is the agent on the other side? Who is the mortgage lender on the other side? Are they competent? Do they know what they're doing, first and foremost? Is the conventional loan putting a huge amount down, right? Is it a 3% down conventional loan, or is it a 50% down conventional loan? Because that could matter at the end of the day. But price is most important, right? So let's think of price first. I'm just talking like most sellers think. Price is important, and then work your way down. If all have the exact same price, then you've got to figure out what the other terms look like, right? What does the escrow term look like? What is the contingency? All of these things are what I would look at versus the type of loan, right? Price, escrow term, how long do they want for contingencies? How long are they willing to shorten them? What are they asking for as far as home warranty? Any credits? Are the agent's compensation? Is all of that's factored in there? And then at the bottom would be the type of loan. Most people shy away from VA. You shouldn't shy away from VA. VA is a great loan. It's probably the most flexible out of all of those, but there's less people that can qualify for them. So we don't often say it's the most lenient because FHA is probably the most lenient overall for everyone. But that's how I would think of it. I don't have a clear-cut answer for you because I would be thinking about other things versus the loan type.
Another wrinkle to this, though, Jeb, Real Estate Curious was the one that asked earlier about the condo in South Florida.
Correct.
So let's say if you have a condo from the loan side, I can tell you conventional loan, FHA or Fannie and Freddie are going to look much more closely at that condo than FHA and VA are, assuming that FHA and VA have a current approval on the complex. So if your agent has already checked and you know that the complex is FHA approved with current data, VA currently approved with current data, it'd be a little bit easier and more likely to close than the conventional. They're all going to look at it. No one's just going to gloss over a condo in Florida at this point in time, but I would say the FHA and VA would be slightly easier from that perspective.
There you go. Good insight there, Josh. Steve, what's your opinion of the best place to raise a family in SoCal? Also buy a single family or a primary residence. 2 kids under 5 will attend private school. Factors to think about. Honestly, there's where in SoCal, right? SoCal is a huge area. It's considered from
Ventura to San Diego.
Yeah, it's a big area. So I would just find, you got to, all of these areas, like if you said just Orange County, like I'm looking at Orange County, there's areas within Orange County that are fantastic areas to raise kids that are 30 miles apart from one another. So I don't really have an answer for you. I say the things to think about are the commute. What do you like to do on your free time? Where are your friends located? All of those things factor in. What you don't want to do is buy a house in a place that you bought it for the wrong reasons, because you'll end up regretting it, right? I mean, if kids aren't in the equation, I wouldn't throw schools out of the equation because they're going to go to private school. You should still think about schools because it's a resale thing. When you go to sell that home in the future, you can't buy in a shitty school district and think, oh, it's not going to affect me. No, it is going to affect you at some point in the future. So something to pay attention to. Work from home, no friends.
Work from home, no friends.
Well, Steve, you can buy anywhere. I would, no, honestly, there's a lot of good places out there. It's, I don't really have a clear-cut answer for you.
Yeah, it's so much. I mean, I could name 10 different communities that would be cool to live in. And my wife
price
and I
point
agree.
matters. All of these things matter.
Yeah.
I mean, say go live on the beach in Newport or Laguna, but it's like, oh, how many people can afford that? So, yeah. got to think a little bit further into that one.
Steve's next comment is, money is no object. I can go anywhere.
Well, then Steve, you are the perfect client. Let's do something.
Let's do business.
Yeah. No, all reality. So, thanks for doing this. We appreciate that. Real Estate Curious says you're great. Thanks for doing this. We appreciate you guys showing up as always. It's New Year's Day. I was going to say New Year's Eve. It's not New Year's Eve. It's the eve of the day after New Year's.
There you go.
No, I don't know what I just said. I just made up something. But anyway, I want to ask you guys a question while we have some people in here at the moment, 120 plus. What do you guys want to hear on the podcast? Do you like the format of this show? These are all things that we're constantly thinking about. We're trying to provide value to you guys as listeners, either of the live and or the podcast, or maybe sometimes both, of things that you want to hear. And I know a lot of it is repetitive because there's only so many things to talk about with housing. And so we want to provide the most value in the least amount of time so that you guys can do what you need to do with it. So if there's something that's, you want us to cover that's not clear, let us know in the comments, because it's the show is here because of you guys. So Josh, do we have any other questions at the moment? Are we out?
I think we burned through them all. I think we get out early on. We get an hour and 10 minutes early because we started an hour early and we don't have any more questions. So we're an hour and 10 minutes early. So we appreciate you guys showing up and letting us go home early.
Yeah, what's going to happen is people that would normally show up at 5 that didn't know are going to start popping on here shortly, and so the numbers are going to grow, and we're going to be like, we got to go, but we don't have to go as long as there's questions, at least at the moment. So. Let's see here. So so you're essentially saying there are 0 loans that finance land and purchase and new construction, only construction on land already owned. So Josh, is that the case? Do you have to own the land, or is there a loan out there that allows you to do everything?
You can do it all. Again, there are not very many lenders. On the wholesale side, I think we have one that does it. There may be some local banks in the area. You're in California. We don't have a lot of regional banks. Other parts of the country, they do, and they may be doing them. But from my perspective, we have one wholesale source. I don't do them. USDA loans are unique. USDA one-time close is a unique subset of that unique subset. So is it out there? Yeah, it's out there. It's available, but not super easy. I don't know how many of them actually get done in a year.
There you go. Yeah, try a local bank. Let's see. Ezrael says, I'm 30, no kids, thinking of buying a house outside of LA County in the areas that I mentioned and possibly in more affordable areas in OC. Rent it out, then live in LA Metro. What do you guys think? I think, well, first off, if you're buying it as a primary home, you're supposed to live there, right? Not buy it, rent it out, and then move. So you got to think that. But also what I would think is, it is very difficult at the moment to buy a property without putting a sizable down payment down and rent it out and the property cash flow, right? So the idea of buying something, renting it out, and moving somewhere else, fantastic. I mean, I hope it works. But what most people don't realize is with taxes, insurance, sometimes HOA, and your mortgage payment, it's very hard to get that property to be less than the amount that you're going to rent it for. So unless you're willing to be upside down for a period of time until rates come down, or you're in a different position, it's not going to be a wise investment. There are better opportunities outside of California for you to do that, but unfortunately, they're going to require a bigger down payment.
That's what I was going to say, Jeb. I get a lot of people asking about this. Hey, I need to be in LA. I make good money, can't afford to buy a $1.5 million house. And so I want to own real estate and I will continue to rent here. The ones that successfully do it end up buying out of state with a 20% down investment loan. So they get the appreciation, they get the principal pay down, get some tax benefits from it. But I would just say, I'm not saying that's not being done. I'm not saying no one buys a place out in Lancaster, lives in it for a year, converts it to a rental. Just for all the reasons Jeb said, the ones that I see that actually successfully pull it off are buying out of state.
All right, good stuff. So, Josh, do we want to sit here and go back and forth, or do we want to wrap this up on
Well,
New Year's?
the football game did not tighten up as hoped. It is 41-15. So we don't have any football to watch. We don't, thanks to terrorists, we don't have a football game to watch tonight. So our thoughts go out to everyone who impacted by that.
Yeah, for sure.
And it sounds like there may be another one in Vegas here. So we got a lot of crazy people here in 2025.
Yeah, so positive thoughts going out to anyone that was affected, that dwells on that sort of stuff. It's impacting them in what in any way. So it's sad that that's what people think they need to do in order to get attention. So, but anyhow, Josh, let's do this. It is 54 minutes in. We have 119 people watching. Any last questions, guys? Throw them in the chat now, and we'll get to them. Otherwise, we're going to call this a night, and we'll be back next week.
And I would say this, Jeb, if you don't want to ask your question here, you have a detailed question, a complex question, you're not sure what your question is, that referral link isn't for only people that say, I am ready to get a loan today. Say, I have a question. I want to have a 5-10 minute quick call where we can get you some details on your information. So if there's any way that we can help, use that referral link. We'll get you connected.
Yeah. So with that said, guys, we appreciate you watching. We'll be back next week, Wednesday night, live. Keep this thing going. We appreciate your support. Until then, adios.
Amigos.